After studying this module, you shall be able to know the meaning and needs of fund flow statement. Learn the methods of preparing funds flow statement. Identify the items which are sources or application of funds. Analyze the fund flow statement and interpret the results. To begin with, the two main financial statements are balance sheet and income statements. The balance sheet gives us the financial position at a given point of time, whereas the income statement shows the financial performance throughout the year. Virtually all items in the balance sheet undergoes a change over a period of time. How these changes occur? Why the firm has liquidity problems despite a good income statement revealing a huge profit? Why is it that despite large borrowings, there is a dearth of cash? The financial statement, which answer these questions, are known as statement of changes in financial position. This may also be called as funds flow statement. Firstly, we will discuss about the concepts of funds flow statement. A fund flow statement is a statement which explains the various sources from which funds were raised and the uses these funds were put to. The reader may notice that this definition of funds flow statement comes discerningly close to the definition of a balance sheet, since liabilities and assets are themselves sources and uses of funds respectively. Even a balance sheet itself may be considered as a form of fund flow statement. Nowadays, the balance sheet of most of the companies are increasingly being expressed in the sources of funds and application of funds format. The major difference, however, between a true funds flow statement and a balance sheet is that the former captures the movement in funds, while the latter merely presents a static picture of the sources and uses of funds. On account of this property, a funds flow statement would enable one to see how the business financed its fixed assets, built up inventory, discharged its liabilities, paid its dividend and taxes, and so on. Similarly, it would enable one to see how the business managed to meet the above capital or revenue expenditure. Was it sourced by raising additional capital or loans from public? Was it by stretching the trade creditors or by incurring some other liabilities? A fund flow statement complements the other financial statements in its informational content. Incidentally, the Accounting Principles Board requires the companies to publish SCFP along with the balance sheet and income statement in their annual report. SCFP means Statement of Changes in Financial Position. Next, we will discuss the preparation of a fund flow statement. The simplest funds flow statement for a period may merely be the difference between the corresponding balance sheet items at the beginning and the end of the period, such that all increases in liabilities and decreases in assets are shown as sources of funds, and all decreases in liabilities and increases in assets are shown as application of funds. Thus, for such a funds flow statement, one needs the opening and closing balance sheets of the period for which the statement is to be prepared. However, a more sophisticated fund flow statement can be prepared with the help of the two balance sheets and the profit and loss statement of the intervening period. Such a fund flow statement defines funds as total resources, and the sources of funds will always be equal to the uses of funds. A funds flow statement may be prepared as to explain only the changes in working capital within bracket current assets minus current liabilities from the beginning of a period to the end of the period. Alternately, it may explain the changes in cash position during the period, or it may be prepared so as to indicate the changes in total resources. Generally, it is conventional to record the changes in the assets and liabilities only if such changes have an impact on the cash or working capital position. For example, if a building is bought against issue of shares of the company, it does not have any impact on the cash or working capital of the company. Therefore, these kinds of transactions should be ignored from the FFS, which means fund flow statement. However, one may choose to include them in FFS if FFS is regarded as a statement of conveying all changes in the assets and liability structure of a business. This may also be justified by the fact that a transaction that results in an ostensible transfer of cash or funds for the business does have an indirect impact on the cash or funds. Next, we will talk about the methods of preparing funds flow statement. There are broadly two methods by which a fund flow statement may be prepared. Fund flow statement on a cash basis, fund flow statement on working capital basis. First, we discuss funds flow statement on a cash basis. A funds flow statement on a cash basis is prepared by the first step will be to classify each item of balance sheet changes that have occurred between 2 points of time into changes that have increased or decreased cash. Then classify each item of income statement that have increased or decreased cash. The final step will be to consolidate this information into sources and application of funds in the funds flow statement. A list of items that are sources of funds and increase cash. If there is a decrease in current assets other than cash, there will be an increase in cash. A gross decrease in fixed assets. A net increase in any of the liabilities will cause an increase in cash. Proceeds from the issue of shares or debentures or preference shares will generate cash. Funds which are generated from operations will increase cash. A list of items that are application of funds and causes decrease in cash. These are as follows. A net increase in any asset other than cash or fixed assets will cause a decrease in cash. A gross decrease in fixed assets. A net decrease in any liability will imply decrease in cash. Redemption or buyback of shares will also decrease cash. Payment of cash dividends is decrease in cash. Second, we will discuss about the fund flow statement on working capital basis. The preparation of funds flow statement on working capital basis is quite similar to the preparation of fund flow statement on cash basis, with the exception that while preparing on working capital basis, changes in the various components of current assets and current liabilities are omitted, and greater attention is given to changes in fixed assets and long-term liabilities. Thus, increase in current assets is taken as increase in working capital, and decrease in current assets is taken as decrease in working capital. Whereas an increase in current liabilities is decrease in working capital, and decrease in current liabilities is increase in working capital. Next, we will discuss about the significance of fund flow statement. An analysis of the sources and uses of funds provides valuable insights into the operations of a firm. It can help in detection of imbalances and thereby taking of corrective timely action. For example,
On analysis, it is found that the debtors have not been paying on time, and the value of total debtors have grown out of proportion in relation to other current assets, total assets and sales. It will immediately raise the alarm and timely corrective action can be taken. Divisional performance appraisal. When a company has a number of divisions, individual fund statements will enable top management to appraise the performance of divisions in relation to the funds committed to each division. Evaluation of the firm's financing. An analysis of the major sources of funds in the past reveals what portion of the firm's growth was financed internally and what portion externally. A funds flow analysis will also tell us whether short-term liabilities have been used to finance fixed assets and permanent portion of working capital, in which case, at least in future, the mix of short-term and long-term finance has to be strictly watched over. Planning of future financing. An analysis of fund flow statement can give us insight into the prospective needs for funds, when these needs will arise, and how these are to be financed. Thus, fund flow analysis is a very important analytical tool in the hands of the finance manager in developing information to be used in financial decision making. Evaluation of the firm's financing. An analysis of the major sources of funds in the past reveals what portion of the firm's growth was financed internally and what portion externally. A funds flow analysis will also tell us whether short-term liabilities have been used to finance fixed assets and permanent portion of working capital, in which case, at least in the future, the mix of short-term and long-term finance has to be strictly watched over. Planning of future financing. An analysis of funds flow statement can give us insight into the prospective needs for funds, when these needs will arise, and how these are to be financed. Thus, funds flow analysis is a very important analytical tool in the hands of the finance manager in developing information to be used in financial decision making. Next, we'll be discussing the practical illustrations. The first illustration we discuss is from the following balance sheets of a company as on 31st December 2014 and 2015, prepare fund flow statement for the year ending December 31, 2015 and schedule of working capital. Additional information is depreciation charged on plant was rupees 4,000. Provision for taxation of rupees 19,000 was made during the year 2015. Interim dividend of rupees 8,000 was paid during the year 2015. The solution to the above problem is as follows. Schedule of changes of working capital. Funds flow statement for the year 31st December 2015. Working notes. Adjusted profit and loss account. Plant and machinery account. Provision for tax account. Another illustration can be from the following balance sheets of a company limited. Make out funds flow statement. Additional information. Depreciation of rupees 10,000 and rupees 20,000 have been charged on plant and land and building respectively in 2015. Interim dividend of rupees 20,000 has been paid in 2015. Income tax rupees 35,000 has been paid during the year 2015. The solution to the above problem is fund flow statement for the year 2015. 1. Statement of changes in working capital, plant account, land and building account, adjusted profit and loss account, proposed dividend account, provision for taxation account. The next illustration we discuss is illustration 3. Following are the summarized balance sheet of Growwell Limited as on 31st March 2014 and 2015. Additional information. During the year ended 31st March 2015, dividend of rupees 23,000 was paid. Assets of another company were purchased for a consideration of rupees 50,000 payable in shares. The following assets were purchased: stock rupees 20,000, machinery rupees 25,000. Machinery was further purchased for rupees 8,000. Depreciation written off on machinery rupees 12,000, and income tax provided during the year rupees 33,000. Loss on sale of machinery rupees 200 was written off to general reserve. You are required to make the funds flow statement. The solution is as follows: funds flow statement, working notes, adjusted profit and loss account, machinery account, provision for taxation account, share capital account, schedule of changes in working capital account.
To summarize, a fund flow statement explains the various sources from which funds are raised and the uses to which these funds are put in a particular year within a company. The statement can be prepared on total resources basis, cash basis, or working capital basis, depending upon the requirement of the user. To prepare the fund flow statement for a company on total resources basis, one has to compare the balance sheets over the period of time. A fund flow statement on cash basis is prepared by classifying net balance sheet changes between 2 points in time into changes that increase and decrease cash, as well as classifying the increase and decrease in cash from the factors available in the income statement. Preparing a fund flow statement on a working capital basis is very similar to prepare a statement on cash basis. The only difference being that the former makes use of changes in the various components of current assets and liabilities and not just cash. An increase in current assets or a decrease in current liabilities results in increase in working capital, while a decrease in current assets and increase in current liabilities cause a decrease in working capital. An analysis of the sources and uses of funds provide valuable insights into the operations of a firm. Detection of imbalances and thereby taking of corrective timely action is possible through fund flow analysis. Evaluation of the firm's financing is possible only through funds flow analysis. Planning of future financing can also be made possible through this analysis.